In the journey of wealth creation, there's one essential skill you must master: the art of investing. Until you learn how to invest wisely, true and lasting wealth will always remain out of reach. Among the many fields available for investment, stocks have become one of the most popular choices. If you are new to the world of investing, today's book summary will be an invaluable starting point for you. Welcome to Audiobook 101, where we don't just summarize books, we bring their lessons to life, helping you apply them practically and meaningfully. Today, we dive into the book The 5 Rules for Successful Stock Investing, written by Pat Dorsey. Pat Dorsey is the founder of Dorsey Asset Management, a renowned investment firm. Before founding his company, he served as Director of Research at Sanibel Captiva Trust Company, an independent trust providing financial services to high net worth individuals. Academically, Pat holds a master's degree in political science from Northwestern University and a bachelor's degree from Wesleyan University. Throughout his career, Pat Dorsey has written 2 influential books: The 5 Rules for Successful Stock Investing and The Little Book That Builds Wealth. Today, we'll be exploring the wisdom packed into the 5 rules for successful stock investing. So without any delay, let's embark on this journey of smart investing. If you're a beginner, the world of investing can feel overwhelming. With thousands of companies and industries out there, it's natural to wonder, when should you buy stocks? When should you sell them? How do you know which companies are truly worth your money? If these questions have ever crossed your mind and kept you from taking action, this summary is for you. It's designed to transform the way you think about investing, giving you a strong foundation to build lasting wealth. By the end of this journey, you'll understand how to assess your investments wisely and make better financial decisions. Let's get started with chapters 1, 2, and 3. The 5 Rules for Successful Stock Investing, 7 Mistakes to Avoid, and Understanding Economic Moats. When it comes to investing, one truth stands firm: your strategy should remain steady over time. Success doesn't come from constantly switching plans. It comes from crafting a smart approach and staying loyal to it. Pat Dorsey outlines 5 essential rules that every stock investor should live by. The first rule: always do your homework. It might sound obvious, but far too many investors jump into the market without truly understanding the businesses they are buying. Before you invest a single dollar, make sure you know exactly what the company does, how it earns money, and who it competes against. Research takes time and effort, but it's non-negotiable if you want to invest wisely. Study financial statements, learn about competitors, and understand the landscape before committing your money. The second rule: look for an economic moat. An economic moat is a company's unique advantage, the thing that keeps competitors at bay. Whether it's a trusted brand, a cost advantage, or a powerful network effect, companies with wide moats are far better positioned for long-term success. Finding these moats is at the heart of smart investing. The third rule: insist on a margin of safety. Discovering a great company is important, but buying it at the right price is even more critical. Overpaying for even the best company can lead to poor returns. Take Coca-Cola, for instance. In the early 1990s, it was, and still is, a stellar business. But investors who paid too high a price were disappointed by their returns because they forgot about the margin of safety. This margin acts as a cushion, protecting you even if your assessment was a bit too optimistic. The fourth rule: think long-term. Imagine buying a car and selling it the next day. Absurd, right? Yet many investors treat stocks exactly that way, buying and selling in quick bursts. Short-term trading piles up costs like taxes and broker fees, eating away at your returns. Real wealth comes from patience, buying great businesses and giving them time to grow. And finally, the fifth rule: know when to sell. Monitoring your portfolio doesn't mean obsessing over stock prices every hour. Instead, keep your focus on the companies themselves. Are they still strong? Is the industry healthy? If a company's fundamentals weaken or its competitive advantage erodes, that's when you should consider selling. But even if you follow these rules, you must also be careful to avoid common traps. Let's explore 7 mistakes that can quietly destroy an investor's journey. The first mistake is chasing big returns through risky stocks. Hoping for massive gains by betting on highly volatile stocks is a recipe for disaster. Remember, lasting success lies in finding strong businesses with real advantages, not gambling on flashy names. The second mistake is believing that this time is different. Markets rise and fall, and history repeats itself more often than we like to admit. During the early 2000s, many believed the rules had changed, only to watch markets collapse when reality returned. Stay grounded. Understand the past. Be wary of anyone who claims that the old lessons no longer apply. The third mistake is falling in love with a product. Just because you adore a company's product doesn't mean it's a smart investment. A great gadget or a popular brand doesn't always translate into big profits. Invest with your head, not your heart. The fourth mistake is panicking when the market drops. When stock prices fall, most people feel fear. But seasoned investors know that downturns often bring the best buying opportunities. Fear is natural, but action based on fear is rarely profitable. The fifth mistake is trying to time the market. No one can consistently predict when the market will rise or fall. Focus instead on owning good companies and holding them through thick and thin. The sixth mistake is ignoring valuation. During bubbles, it's easy to get swept up in the excitement, but price and value are not the same thing. A high-flying stock may still be a terrible investment if it's massively overvalued. Always anchor your decisions in rational analysis, not emotions. And the seventh mistake, blindly trusting earnings reports. Earnings can be manipulated or distorted. Real insight lies in examining a company's cash flow, the true lifeblood of any business. Strong cash flow is a far more reliable sign of a healthy company than neatly packaged earnings numbers. Now that you know what to aim for and what to avoid, it's time to learn how to evaluate a company and uncover its true economic moat. Here's a simple but powerful 4-step process. First, assess profitability. Examine how much cash the company generates. Compare its returns against those of its peers. Higher returns on assets often signal stronger, more efficient operations. Second, identify the source of the economic moat. Ask, why can't competitors easily take away this company's customers? What unique strengths does the company possess? Third, determine how durable the moat is. It's not enough to have an advantage today. You must judge whether that edge will survive 5 or 10 years into the future. And fourth, analyze the industry. You don't need to become an expert in every detail, but you do need to understand the basic health of the sector, how sales are trending, how profits are evolving, and how intense the competition is. With these principles, you'll be better equipped to choose the right companies, avoid costly mistakes, and build real wealth through smart investing. Stay tuned. The journey is just getting started. Chapters 4, 5, and 6. The language of investing and how to analyze a company. Before you can become a successful investor, you must first learn the language of investing. Fortunately, you don't need a degree in finance to understand it. There are three basic financial statements that can make the business of investing much easier: the balance sheet, the income statement, and the cash flow statement. Let's start with the balance sheet. Think of it as a company's credit report. It shows you what a company owns, its assets, and what it owes, its liabilities. In simple terms, it's a snapshot of the company's financial position at a specific point in time. Next comes the income statement. While the balance sheet shows what a company owns and owes, the income statement tells you how much money the company made and how much it lost over a period of time, typically a year. It captures the company's revenue, expenses, and ultimately its net profit or loss. Finally, there's the cash flow statement. This document tracks the actual movement of cash in and out of the business. It tells you whether a company is truly generating cash, which is vital because profits recorded on the income statement don't always translate into real money in the bank. You might wonder, what's the difference between the income statement and the cash flow statement? Let's break it down with a simple example. Imagine Colgate sells toothpaste worth $1,000 to Joe's corner store. Joe, being a loyal customer, is given 60 days to pay. By the end of the month, Joe hasn't yet paid, but Colgate has already prepared its quarterly financial report. In Colgate's income statement, that $1,000 sale will still be recorded as revenue, even though no cash has been received yet. On the balance sheet, it will appear as an outstanding receivable, meaning money that is still owed by Joe. This highlights an important point. While the income statement records sales when the transaction happens, the cash flow statement tracks when the actual money changes hands. Understanding this distinction is crucial because companies can sometimes show strong earnings on paper while struggling with actual cash flow problems. Going back to the balance sheet, it also records the company's equity, the difference between its assets and liabilities. Equity represents the true value that belongs to the shareholders. When analyzing financials, it's important to pay attention to both sales and revenue. If a company shows strong sales on its income statement but hasn't actually received the cash, it could run into problems later. Real financial strength lies in actual cash in hand, not just in reported sales figures. Now that you understand the three key financial statements, you're ready to start analyzing companies more deeply. Analyzing a company might seem intimidating at first, but it becomes much simpler if you break it down into 5 clear stages. 1. Growth. First, ask, how fast is the company growing, and what's driving that growth? Growth attracts attention. It excites investors and can fuel higher stock prices. However, just because a company has grown in the past doesn't guarantee it will continue to do so in the future. Growth usually comes from 4 sources: selling more products or services, raising prices, launching new products or services, or acquiring other companies. When evaluating growth, look beyond the numbers. Understand what's fueling it and whether it's sustainable. 2. Profitability analysis. Once you understand growth, focus on how efficiently the company turns investment into profit. Is it generating strong returns relative to its invested capital? Great companies consistently deliver higher returns compared to average ones. One way to uncover a company's real profitability is to compare its cash flow against its reported earnings. Healthy cash flow supports the idea that reported profits are real and sustainable. 3. Financial health. Profitability alone isn't enough. You must also examine the company's financial foundation. Is it standing on solid ground or drowning in debt? A strong company maintains manageable debt levels and has enough liquidity to survive tough times. Heavy debt can be a red flag, signaling that trouble could be around the corner. The bear case. Finally, before you invest, think like a skeptic. What could go wrong with this company? Imagine the worst-case scenarios. Could a competitor steal its market share? Could technological changes make its products obsolete? Could regulatory issues cripple its business? Identifying the potential risks in advance helps you invest with your eyes wide open and prepares you to act if trouble arises. By mastering the language of investing and learning how to analyze businesses in a structured way, you'll develop the confidence and clarity needed to make smarter investment decisions rooted in reality, not hype. And with these skills, you'll move one step closer to building lasting wealth through intelligent investing. Chapters 7, 8, and 9. The fifth stage of analysis, great management. As we move to the fifth and final stage of company analysis, we enter a critical area, evaluating management quality. This stage is essential because it often separates an average business from a truly exceptional one. A company's management team plays a pivotal role in determining its long-term success. You want to invest in businesses where managers act like true stakeholders, treating the company's money as if it were their own. Their decisions should reflect the mindset of owners, not just employees collecting a paycheck. Because this aspect is so important, Pat Dorsey recommends breaking it down into 3 specific areas of focus. 1. Compensation. First, look at how the management team is paid. A single document, known as the proxy statement, can tell you everything you need to know. Start by checking how much the top executives are compensating themselves. Ideally, compensation should be aligned with company performance, rewarding success without encouraging reckless risk-taking. Be cautious if executives are paying themselves excessively large salaries, especially when compared to their peers at competing companies. Compare CEO salaries across similar businesses to make sure you're not investing in a company where management is enriching themselves at shareholders' expense. 2. Character. After evaluating compensation, dig deeper into the character of the management team. Are they using their position for personal gain, favoring family and friends, or engaging in unethical practices? One major red flag is when family members of the executives sit on the company's board of directors or receive lucrative business contracts. For example, if you discover that a company is paying large sums to an interior design firm run by the CEO's spouse, it's a warning sign. These conflicts of interest suggest that management may not have shareholders' best interests at heart. Trustworthy management is transparent, ethical, and focused on building the business, not using it for personal favors. 3. Business operations. Finally, good managers not only need to be honest, but also highly competent. They must be skilled at running and growing the business effectively. Pay close attention to how management responds to problems. When challenges arise, as they inevitably do they acknowledge the issues openly and take concrete steps to fix them? Or do they hide problems, offer vague promises, and delay real solutions? One key warning sign is deteriorating cash flow. If cash flow starts to fall while reported income stays high, something could be wrong beneath the surface. Take the example of Lucent Technologies. In the late 1990s, Lucent's reported income continued to rise, reaching around $3.5 billion. On paper, things looked good, but behind the scenes, cash flow was drying up. Sales were high, but customers were taking longer to pay, and Lucent was piling up unsold inventory. Instead of recognizing the storage costs and liquidity risks building up, management ignored them. Ultimately, this poor cash flow management led to serious trouble for the company. That's why it's so important to watch not just what managers say, but what they do, and to measure their effectiveness by tracking real cash flow, not just optimistic earnings reports. By carefully evaluating compensation, character, and operational skill, you can spot companies with truly great leadership, the kind of businesses that are more likely to grow steadily, weather storms, and deliver outstanding returns over the long term. Chapters 10, 11, and 12. Valuation. Understanding intrinsic value. Before buying any stock, it's crucial to know not just its price, but its true worth. Many investors make the mistake of relying solely on various financial ratios, but no single ratio can accurately tell you a company's real value. That's where the concept of intrinsic value comes in. Intrinsic value helps you focus on the actual worth of the business, not just its stock price. It's the foundation for intelligent investing. But what exactly is a stock's intrinsic value? An economist named Irving Fisher answered this question over 60 years ago. He explained that the true value of any stock is the present value of its future cash flows. Now, that might sound a little complicated at first, so let's break it down. When a company earns profits, part of that money goes toward covering expenses and reinvestment into the business. What remains, the leftover cash, is called free cash flow. This free cash flow is what truly belongs to shareholders. However, there's something important you must understand. A dollar earned in the future is worth less than a dollar earned today. Why? Because money you have today can be invested and grown, while money promised in the future cannot be used right now. Additionally, there's always the risk that future cash flows may never materialize. Think of it like this. Imagine you ask your boss for a 1-week vacation, but instead he tells you to take it next year. Because of the delay, you would be justified in asking for 8 days off instead of 7 to make up for the wait. The same logic applies when valuing stocks. The further into the future the cash flow is, the less valuable it becomes today. Now that we understand how intrinsic value works, let's apply everything we've learned so far by analyzing a real company. Advanced Micro Devices, or AMD, a company that manufactures microprocessors. First, let's look at AMD's economic moat. In the early 1990s, AMD's free cash flow turned negative. Why? Because the company was heavily reinvesting its earnings back into the business, increasing its expenses significantly. While some reinvestment is necessary for growth, consistent negative cash flow can be a worrying sign. Many companies do face negative cash flow while trying to build an economic moat, but truly, great businesses usually have clear evidence to prove that the investment is paying off. In AMD's case, their revenue growth wasn't terrible, but it wasn't particularly impressive either. When we examine their financial health, things look even shakier. By the end of 2002, AMD was carrying nearly $1.9 billion in debt, a heavy burden for any company. Turning to management, we find more concerns. CEO Jerry Sanders was drawing an annual salary of $1 million, and the other top executives were also being highly compensated. When compared to the company's financial struggles, this level of executive pay appears excessive. It suggests that management might have been prioritizing their own interests over those of shareholders. Finally, let's talk about valuation. Over the previous 2 years, AMD had lost a substantial amount of money. Given its weak cash flow, heavy debt, modest growth, and questionable management practices, AMD appeared to be a highly volatile stock, prone to sharp ups and downs. It was clear that AMD was not a safe long-term investment at that time. By applying everything we've learned, from analyzing economic moats, profitability, financial health, management quality, and valuation, we can make better informed decisions about whether a company is truly worth investing in. In AMD's case, the answer was clear. Despite some strengths, the risks far outweighed the potential rewards. A smart investor would be wise to look elsewhere for better opportunities. Chapters 13, 14, and 15. Healthcare and Consumer Services. When it comes to investing, healthcare is a sector closely tied to human life itself. Because of its essential nature, investors can often expect returns that outperform the average market. In terms of economic moats, healthcare companies typically benefit from strong patent protections and high startup costs, both of which help them fend off competition. Pharmaceutical companies, in particular, can be attractive investments, offering the potential for high returns. However, not all drug makers guarantee success. Developing new drugs is a costly and time-consuming process, and not every drug ends up being successful. This uncertainty means pharmaceutical investments carry inherent risks. Similarly, while biotechnology startups can deliver impressive profits, they should be approached with caution. Unless you thoroughly understand what the company is developing and the market it operates in, it's wise to hold off on investing. Only once you are confident in your knowledge should you enter this market. Another area worth exploring is the medical devices industry, which can offer steady returns. But even here, investors must stay alert to government policies, regulations, and reforms that could impact healthcare businesses in unexpected ways. Moving on to consumer services. We encounter businesses we interact with daily: restaurants, retailers, and service providers. Companies like McDonald's, Target, and Gap all fall into this sector. Over the past few decades, the consumer service sector has expanded significantly. Restaurants, in particular, can be divided into two main categories: quick service restaurants, QSR, where customers order and pay at a counter before receiving their food, and full-service restaurants, FSR, where waitstaff take orders and serve customers at their tables. Restaurant dining has grown increasingly popular. However, many restaurants that experience early success eventually struggle to maintain that momentum. While giants like McDonald's and KFC have established themselves as enduring brands, most restaurant chains find it extremely difficult to replicate such long-term success. In general, consumer service businesses can grow rapidly, but their lifespan is often limited. When considering investments in this sector, look for companies that have earned customer loyalty and built strong brands. And remember, always compare a company's performance to its competitors before investing. Chapters 16, 17, and 18. Business Services, Airlines, and Banks. The business services sector includes companies involved in waste management, advertising, and airlines. It can be categorized into three broad types based on their foundation: technology-based, people-based, and hard asset-based services. In business services, scale matters. Many companies dominate their niche markets, creating mini-monopolies where it becomes extremely difficult for new competitors to enter. Technology-based companies like data processors and database providers often become attractive investments, especially when their stock prices dip to reasonable levels. People-based businesses, such as consulting firms and advisors, rely heavily on human expertise. While they can sometimes appear attractive, they are generally less scalable and less profitable compared to technology-driven businesses. Finally, there are hard asset-based companies, such as airlines and waste management firms. These businesses require significant upfront investments in physical assets, making them capital-intensive by nature. Historically, airlines have been notoriously poor performers from an investment standpoint. There are very few airline companies that consistently deliver strong returns. Invest cautiously in this industry, and only after thoroughly assessing long-term profitability and market stability. When evaluating business services companies, ask yourself, which of the three categories, technology, people, or hard assets, does the company belong to? How large is its scale, and how consistent is its revenue? What do the cash flow trends look like? And finally, are the company's future growth expectations realistic? If projected growth rates seem overly optimistic or unlikely, it's better to walk away. Banking is another sector that demands careful risk evaluation. Banks can be analyzed based on three types of risk: credit risk, liquidity risk, and interest rate risk. Credit risk refers to the potential loss that occurs when borrowers fail to repay their loans. Liquidity risk arises when a bank struggles to meet its short-term obligations, and interest rate risk reflects the impact of fluctuating interest rates, which can affect the value of bonds and other financial products. When choosing which banks to invest in, always assess the types of risks they face. Look for banks that demonstrate stable and consistent net income growth. Such institutions are better positioned to weather economic cycles and deliver steady returns to their investors. Chapters 19, 20, and 21: Software, Hardware, and Media Industries. Let's begin with the software industry. This is a highly competitive space, but also one with incredible opportunities for smart investors. In software, the creation costs, the costs of developing a new product, are very high. But once the product is built, the production and distribution costs are extremely low. Thanks to the Internet, software can be delivered almost instantly at virtually no cost. This dynamic allows successful companies to scale quickly and generate huge profits. Within the software world, companies built around operating systems tend to dominate. Take Microsoft's Windows, for example. It runs on more than 90% of the world's personal computers. Meanwhile, Linux is growing in popularity, especially on servers, but struggles to generate revenue because many versions of Linux are distributed free online. In the database sector, three players stand out: Oracle, IBM, and Microsoft. Oracle holds a technological edge, but IBM and Microsoft often compete more effectively on pricing. Thus, while strong technology matters, pricing power and market strategy are equally critical when evaluating these companies. In the video game industry, Electronic Arts is a recognized leader. However, as an investor, you shouldn't just chase the company with the flashiest technology. Instead, focus on companies with the strongest growth potential and sustainable competitive advantages, not just temporary popularity. Technology changes quickly, and today's leaders can easily become tomorrow's laggards. Next, let's turn to the hardware sector, an even tougher battlefield. Finding a sustainable economic moat in hardware is extremely challenging. If you've ever bought a computer, you've seen it firsthand. A better, cheaper version is always just around the corner. Competition is fierce, and price wars are brutal. Producers constantly race to offer more at lower prices, squeezing profit margins across the industry. To invest wisely in hardware, you need to find companies with a low-cost advantage, firms that can operate efficiently even in cutthroat conditions. Dell, for example, built its empire by mastering low-cost production and direct-to-consumer sales. When you identify a company that has a genuine advantage over its rivals, you increase your chances of earning returns that exceed the market average. Finally, let's look at the media sector, an area that offers great opportunities for long-term investors. The key is to find companies that consistently generate strong cash flows year after year. Dig into their balance sheets to assess their financial health. Are they carrying dangerous levels of debt, or are they managing their resources wisely, reinvesting profits, and growing steadily? One important warning: do not get caught up in hype or trends. Just because a media company is hot right now, dominating headlines and social media, doesn't mean it's a smart investment. Following the crowd rarely leads to long-term success. Instead, focus on hard data, cash flow strength, and fundamental business performance. In the media world, as in every sector, sound research beats speculation every time. Chapters 22 and 23. Telecommunications and Consumer Goods. Let's start with the telecommunications sector. If you're hoping for extraordinary returns from telecom companies, you might be disappointed. Historically, most telecom businesses deliver only average returns, and their economic moats are often weak or non-existent. However, the future of telecom may look quite different. Technological changes are happening at a rapid pace, which is both a challenge and an opportunity. Competition in this sector is fierce, and it will likely become even more intense over time. When evaluating telecom companies, it's crucial to look closely at their resources and financial structure. Telecommunications is a capital-intensive business. Building and maintaining vast networks requires massive investments. Therefore, you must carefully assess whether a company is burdened with too much debt. Companies that take on heavy debt to build infrastructure often face high risks, especially if market conditions shift. Another important point: telecom companies often compete aggressively on price. They must constantly monitor and react to their competitors' pricing strategies, leading to margin pressures and reduced profitability. Because of these factors, high competition, high capital costs, and weak moats, investing in telecom requires extreme caution. Look for companies with strong balance sheets, prudent management, and the ability to adapt to rapid technological changes. Now, let's shift to a more promising area, as consumer goods. Consumer goods companies produce the everyday products you find all around you. Open your refrigerator or your bathroom drawer, and you'll see dozens of examples. This sector includes food and beverages, household items, and personal care products. While the consumer goods industry doesn't usually grow faster than the general economy, it can still deliver excellent returns over the long term. Why? Because consumers continue to buy these essentials regardless of economic cycles. When investing in consumer goods companies, look for firms with a strong competitive advantage over their rivals. Focus on companies that consistently deliver high-quality products, maintain strong brand loyalty, and invest smartly in advertising and marketing. Pay attention to how well a company manages its cash flow. Strong cash flow management is often a sign of disciplined leadership and sustainable business practices. And remember, to maximize your returns while minimizing risk, always insist on a margin of safety, ideally around 20 to 30%. This safety cushion protects you against unexpected market downturns and ensures you're not overpaying for future growth. By carefully selecting businesses with strong fundamentals and competitive edges, you can position yourself to achieve consistent, reliable returns, even in sectors as diverse as telecom and consumer goods. Conclusion: if you don't do your research, you won't know how to invest. Without understanding how to manage risk, investing becomes nothing more than gambling. That's why every principle we discussed throughout this summary is essential for anyone who wants to succeed as an investor. You've now explored a wide range of industries, from healthcare and consumer goods to telecom and technology, and learned about the specific risks and opportunities each sector presents. You've understood when to buy a stock, when to hold it, and when it might be time to sell. You've seen how vital it is to study a company's economic moat, financial health, management quality, and valuation before making any decisions. Most importantly, you've learned how to reduce risk, the true key to building lasting wealth through stock investing. Armed with this knowledge, you are no longer just guessing or hoping for success. You are now prepared to approach the stock market with clarity, confidence, and discipline. You are ready to invest wisely and to let your journey toward financial growth and independence truly begin.